Last time our next guest was on CNBC, he was expecting Bitcoin to be $150,000 by the end of the year. Want to find out if he's changed his tune since late October, given the recent move in the crypto space. You're looking at Bitcoin right now at $94,000, 632. Michael Saylor is here, strategy founder and executive chairman. Good morning to you. What do you think? 150 by the end of the year? What do you think's happening here?
You know, I think we all want to go to the moon, but if you want to ride the rocket, you got to be prepared to pull the G's. Over 5 years, Bitcoin's had like 6 brutal drawdowns. If you roll the clock back 13 months, we were sitting around 68,000. And then after the Trump election, we had this incredible rally from 68 to 106,000 in 5 weeks. If you go back 14 months, we were about 55,000. And so if you'd said we're going to go from 55,000 to 94,000 in 14 months, that would have exceeded any reasonable investor's expectations. Over 5 years, Bitcoin's up about 50% a year on average for the 5 years. Gold and S&P are studying the cost of capital to 14%. My company's strategy is up 71%, equivalent to NVIDIA. There's no other stock in the S&P that's done any better. So I think the volatility comes with the territory. If you're going to be a Bitcoin investor, you need a 4-year time horizon, and you need to be prepared to handle the volatility in this market.
So when you look at the price right now, and then we'll talk about the implications for strategy, but when you look at the price right now, what does the upside at this moment look like to you?
In a recent CNBC interview, Michael Saylor describes something most new investors overlook. Investors completely misunderstand. Bitcoin doesn't move in straight lines. It moves in eras. His analogy about surviving repeated drawdowns is his way of reminding people that Bitcoin's long-term value comes from its ability to recover stronger every single cycle. No traditional asset behaves this way. Gold doesn't. Stocks don't. Even major tech companies don't produce this kind of asymmetric long-term return. Here's the key insight. Every drawdown cleans out weak hands and leverage, while every recovery happens with a stronger base of conviction. It's like watching an immune system grow stronger after every shock. And when he compares Bitcoin's 5-year performance to gold, S&P, and even NVIDIA, Saylor is really telling us that Bitcoin's volatility is the price of admission for generational upside. Anyone expecting that without turbulence is chasing fantasy, not investing. Now, let's get more from Saylor's insights.
And what does the downside in this moment look like to you?
You know, I feel like we put in a pretty strong base of support around here. There's an incredible amount of leverage coming out of the system, a lot of liquidation. A lot of the OG holders were selling at the $100,000 level, and so I'm fairly comfortable at this level. I would think that we'll build from this base and we'll rally from here. Obviously, it's hard to make a forecast for the end of the year right now, given what's happened over the past few weeks, and especially the shift in the macro environment. But, you know, as you know, my view is Bitcoin's going to outperform gold. It's going to outperform the S&P. It is digital capital. And so if you're a long-term investor, this is the place to be.
In terms of the way your fund is structured and the debt that you've taken out to effectively buy Bitcoin, what are the trigger points, just so people understand the full risks involved for you in terms of some of these preferreds and other things, in terms of where Bitcoin needs to lie, either on the low end?
Well, I mean, it's pretty important to note that we're not even 1.15 times levered. We're very fractionally levered, and our debt that we have is 4.5 years out. So we don't really have any trigger points anytime soon. And if Bitcoin were to fall 80%, we're still over collateralized and we're fine. So our balance sheet's pretty stable. The company's strategy, just like an intelligent bank, would be to build amplification for the common stock using preferred equity. So the equity never comes due. It's a dividend payment declared by the board. It's not a coupon. We can't be in a default. There is no credit default situation from the digital credit that we're selling at this point.
I was curious if you could comment on something we heard from Cathie Wood last week. She has a target, I think by 2030, she had it at $1.5 million a coin, and recently suggested it might actually be closer to a 1.2, which is still pretty remarkable unto itself. And yet, when she explained her new rationale, it was actually that stable coins, the sort of emergence of stable coins and the growth of those coins being used for transactions, she argued could ultimately crowd out some of the use case for Bitcoin. What did you think when she said that?
I think the entire digital assets economy is exploding and growing in a bunch of different dimensions. Right now,
Michael Saylor simplifies a debate that confuses almost everyone: Bitcoin versus stablecoins versus Ethereum-based assets. His point is that Bitcoin is digital capital, not a payment token, not a DeFi tool, not a currency for daily transactions. It's the base monetary layer, the digital equivalent of prime real estate or pristine gold. Stablecoins, on the other hand, are more like the digital dollar: fast, efficient, transactional. Ethereum and Solana power the infrastructure behind those applications. None of these sectors compete. They actually reinforce each other. As stablecoins grow into the trillions and tokenization expands, they funnel more liquidity, more on-ramps, and more global adoption into the digital asset economy, with Bitcoin sitting at the top as the ultimate reserve asset. Realistically, what Saylor is really saying is that Bitcoin isn't threatened by innovation. It benefits from it. Let's get more of his insights.
now the way to think of it is that half of the economy is built around Bitcoin. It's digital capital. Bitcoin is digital gold. And the killer application on top of digital capital is digital credit. Instruments like Stretch, STRC, credit instruments that pay yield. And that's a very simple business. The other half of the economy is digital finance. And it's going to be built on the proof-of-stake networks that are emerging, the Ethereum Solanas, the BNBs. And the killer application for that part of the digital assets economy is tokenized currencies, a la stablecoins, tokenized securities, tokenized real-world assets, tokenized brands, and DeFi in general. Well, that's a very complicated technical development, and I'm sure that stablecoins are going to go from hundreds of billions to trillions of dollars, but it's not really competing with digital capital. No rich person wants to buy the currency instead of an equity or a real estate or a capital asset.
Michael, given where Bitcoin's trading right now, are you buying?
We are buying. We're buying quite a lot, actually, and we'll actually report our next buys on Monday morning. I think people will be pleasantly surprised. In fact, we've been accelerating our purchases.
Are you ever not buying, Michael?
No, we're always buying. Bitcoin's always a good investment.
But no, that's interesting, though, in terms of buying today at $95,364 versus buying 2 or 3 weeks ago. You're saying you were buying at both. If you were to look over the last year, sort of at your average, do you weight the buying based on trading?
We now own nearly 3.1% of the network, and we bought it on a blended average about $74,000 a coin. The point that I would make for any investor is, if you have money you don't need for 4 years or longer, and if you don't trust anybody, you want no counterparties, you just want to own a piece of the global digital economy, you buy Bitcoin. It's the commodity. If you're an equity investor and you want to bet on digital credit and you want to bet on digital capital and you want some amplification, you buy an equity like MSTR. Right. If you have money for less than 4 years and you're an investor and your time frame is 12 weeks, you should buy the digital credit. For example, the credit instruments we've created have stripped the volatility off of Bitcoin. Bitcoin's vol is like 45 on a trailing 30-day average. We have instruments at 28, 21, 15, and Stretch is a vol of 8. So if what you want is like a serious yield, you want the credit. You don't want the equity or the commodity.
At the end of the day, Saylor's message is simple but powerful. Bitcoin is long-term digital capital, not a short-term trade. Volatility isn't a flaw. It's the engine that clears excess, resets the market, and strengthens the asset for its next phase of adoption. And as the broader digital economy expands with stablecoins, tokenization, and crypto infrastructure, Bitcoin sits at the center of it all as the reserve asset everything else eventually refers back to. If you found these insights helpful, make sure you like this video, share it, and drop a comment with your thoughts. And if you want more sharp, data-driven updates on Bitcoin and the entire crypto market, subscribe to the channel. There's much more coming. Thanks for watching.